party to the team that actually devised the fully accessible route so that the bond inclusion becomes a reality. First thoughts?
Well, I mean, this has been in the works for some time, so it's good that finally it came through. As you know,
I don't think we can hear you, Sanjeev.
Can you hear me now?
Please repeat yourself.
Yeah. So, I mean, it's been in the works for some time, so it's not a complete surprise. As you know, this has to go through several processes, both on our side as well as on the investor side. So all those processes had to go through. So now we are now in place for the inclusion. And so from what I gather, it will eventually go up to about 10% of the JPMorgan EM index, which accounts for about, as things stand, about $24 billion worth of inflows. Now, do remember that this is not the only index. There are several other indices like the Barclays Bloomberg one, there is an FTSE one, and so on. So there are other indices as well. And so assuming that over time this kind of becomes generalized and we become a normalized part of the global indices, then this can account as much as something like $40 billion worth of inflows. And they tend to be reasonably stable compared to other forms of indices because this is a passive form of investing. Monies are put into the proportions. And yes, those percentages go up and down. So it's not like it's completely stable. But compared to most other sources of inflows, these tend to be reasonably stable.
Now, as an economist, what do you see as the macro benefits?
Well, this is, I mean, let's not blow it out of proportion. This is one more form of inflow and access to capital that we have. In the long run, it positions ourselves as part of the global economy. It lowers the cost of capital in India, both for the government, but overall as well. So in that sense, it is good for bringing down the cost of capital in India, something that is historically been high by the standards of most of our export competitors. So in that sense, it's good. And of course, for the fiscal as well, because these are government bonds. So they will now be at a lower interest rate than would have otherwise been the case. So in that sense, the interest cost into the future will be lower than would otherwise have been.
But would investors even perceive that the twin deficits, current account and fiscal deficit, are more manageable now because there is a large, deep-pocketed set of investors who are coming? So perception of macros should improve, you think?
Well, as with all these things, you tend to have these things go in virtuous cycles. So because you get cheaper capital, so therefore your economic growth is better, your ability to, repay them is better because you're getting this at a lower interest rate, and so on and so forth. So as with all these things go into virtuous cycles. So this is one more sort of step in that direction. I mean, in itself, it wouldn't be worth very much, but as you just yourself mentioned, we are in a good macro situation. Our current account is well managed. By historical standards, our inflation has been well managed over the last many years. Growth is good. Debt to GDP ratios are coming down. So overall, we are in a good position.
This increase the Reserve Bank's headache in terms of, an appreciating currency. After all, the Chinese yuan is, depreciating or has depreciated a lot over the past 12 months. And we have a big deficit with that country. So they will have to work overtime to keep the rupee from appreciating too much?
Well, we have a well-established way in which we handle the exchange rate. And we will continue with that, which is that more or less in the medium term, we let the rupee find its level. But yes, we do lean against the wind in both directions, both up and down. And that's why the foreign exchange reserves worth of 600 billion is there. And we are not afraid to use that, as you have seen. So I don't think there'll be any change in the way the Reserve Bank will manage the rupee. It will be allowed to find its own level in the medium term with, as I said, use of reserves to lean against the wind for short-term fluctuations.
Made the calculation that there's $22 billion because of the inclusion into the JPM bond index. And then if Bloomberg, Barclays and FTSE Russell were to do just the same, it's about $40 billion. Do you think now active funds, will now look at this as a great reason to front run. Do you think we can get another $10 billion simply because active funds will apportion more?
That may happen. I mean, but that tends to be opportunistic. So those funds tend to come in and leave. And sure, our markets have now become much more liquid. We have a lot more depth. So we can get, we can deal with those kinds of fluctuations. But these index-linked bond, whether it's equity or debt, money tends to be much more stable. And so we tend to have a preference for these more passive, slow-moving money than would be the active ones which go in and out at the bat of an eyelid. So I think as a general principle, we prefer slow money. This is not to suggest that we are not a part of the market economy, and some volatility is also okay. But as I said, this particular source of funds is good because it tends to bring in slow money, because this tends to be tied to this a weightage in the bond, and except in very extreme situations, these things don't move around too much.
I agree with you. Of course, these are passive funds, and therefore it's more or less a given, and therefore more reliable. Any back-of-the-envelope calculation on how much the cost of capital or the interest burden can come down? I mean, do you think it's a 25 basis point fall in the cost of money for the government of India, or even more than that? Could it be, well below 7% for the 10-year?
No, you can't calculate those kinds of things. Many people will make these models and claim them. I can assure you, having worked in financial markets for 2 odd decades, none of those models give you any reasonable forecast. So we know that it will be somewhat or significantly lower than what it would have otherwise be, but it's impossible to put a hard number to it.
Okay. What's the next big or next important step that you are looking forward to in the bond markets to make them, more robust, more deep, more widely traded?
Well, I'm not looking at any specific measure at this one juncture. Our approach throughout has been feedback loop and adjust small incremental changes. So we keep doing those things, and it has served us well, because it means that we can keep improving things without having to do any radical changes to the system, because the system overall now works. This is not, we are not in the 1990s or the 2000s where the market itself didn't exist. Now we have a well-established market. There are well-established players. Their rules are more or less clear. So we can get away with making incremental changes. Over time, those changes add up, and I would continue to be, with that approach.
Okay. Time permitting, I'll come back to the bond markets, but there was another piece of data that came out from the Reserve Bank when it released its bulletin last week. We discovered that our household financial savings net have fallen to a 47-year low. That's because financial indebtedness, household financial loans have gone up. Would that be a cause of bother? Do you think that could be a constraint on growth?
Not in any specific way. I mean, what came across is that Indian households had a preference for physical assets like real estate and so on. And that may be an utterly realistic thing for Indian households to do. What we care for from a macro stability perspective is overall savings. So in the end, why do we care about this? Because the difference between our investment rate and our savings rate is the current account. And if we try to invest faster, but we do not get more savings, we will end up with a large current account deficit and have external problems. So from a macro stability perspective, we do care about whether or not the overall savings rate is going up or down. Specifically for the financial sector vis-a-vis other assets, all I will say is that that may matter for the specific sector. So for example, the insurance people may care whether savings are coming to insurance, or the equities people may care whether savings are coming to equities. But for the macroeconomist or the overall managers of the economy, it is not that significant an issue.
Just a final set of questions on the global situation. The US bond, 10-year bond yield has now gone to 4.5%, a level we have not seen perhaps maybe since the time you were in the markets, maybe 2005 or thereabouts. Is that a bother? You think that can, this global rise in the cost of capital can be a constraint to growth? We too can't push our yields too much lower if the global cost of capital is that high, you think?
It's certainly a concern that the cost of capital in the rest of the world has gone up and they've had to tighten so sharply. Indeed, we had warned the rest of the world very clearly during the COVID period not to go out there and splurge on their monetary and fiscal levers in the way they did, warning them exactly what would happen, which is that they would end up indebted and with high inflation. But now that they have had to do this tightening, it is annoying, because it does mean that global liquidity is tighter than would, otherwise have been. And, they are attempting to slow down growth, and therefore global trade and so on have also been impacted. So in that sense, it is something that could have been avoided. Also important from the perspective of some of these Western countries in particular, what is happening is that as they continue to tighten, but not carrying out adequate fiscal corrections, it is also stressing their financial system, a point that I have also made repeatedly. For example, in the US, they have continued to have what I think is still reasonably loose fiscal policy, and they're continuing to compensate for it with ever tighter monetary policy. And not surprisingly, that is causing stress to their banks. And you keep hearing small banks going bust all the time in the US. So this disbalance is something that the Western macro managers, whether fiscal or monetary, need to do something about. And unless they rebalance this, we will continue to be in this curious position. So I think what we really need is, the mix between fiscal and monetary has to be rebalanced in the North Atlantic, and that would be good for everybody. And of course, there is the other issue of global oil prices, which are also, I think, unnecessarily high. They've gone up well past $90 per barrel again. And I think here it would be good to see oil producers to come together, including OPEC, to look at how to ease energy supplies and bring them back again.
That was going to be my last question. Given those kinds of headwinds, do you think that the 6.5% growth that is the Reserve Bank's target, and I think the assumption of the budget as well, is a bit of a stretch this year?
No, we have been conservative in that throughout. As you know, we have kept saying 6.5% to 7%. The first quarter number, as you know, came out at 7.7%, so well above this target range. But we have made the point throughout that the first quarter did benefit a little bit from a statistical factors, but nevertheless, the momentum is there to be able to get within the 6.5% to 7% range. So although the headline number will come off in the next few quarters, the growth momentum remains strong. And whether it's in services, but even in corporate investing and other things, we are continuing to see reasonably good, strong numbers. Every month you see the PMI numbers; they're super hot. You look at many indicators, corporate profitability or whatever else you want to see, GST numbers. They all tend to suggest that there is good, solid momentum in our economy, despite the fact that the external environment is not so conducive.
We'll leave that on that high note. Thank you very much, Sanjeev Sanyal, for joining us on what's a very big day for the Indian bond markets. A big investor, the set of passive emerging market debt funds now more likely to buy and pour in, as Sanjeev Sanyal said, $20 billion to $40 billion in the next 12 to 18 months. Thank you very much, Sanjeev Sanyal.
Thank you.
Right. Over to you, Sonia.
Thanks a lot, Latha, for that. And as Sanjeev Sanyal said, right, this is just one more form of inflow and access to the capital markets, to capital rather. So, of course...